Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hey everybody, it's Bill Rodriguez and Bill the Lender podcast. Welcome to this week's episode. This week we have Dan Grote with Latitude Financial Group. Dan has over 20 years of experience in the financial planning profession, assisting his clients with their planning for retirement, college, insurance, and investment management. He is a certified financial planner and behavior financial advisor. Dan's ongoing professional growth is in the field of psychology, which he enjoys with his wife, Dana, a licensed clinical psychologist. His passion to help people understand that learning why we adopt our money management instincts, what it can reveal about overcoming self-defeating money behaviors, and how relationships can be healed and future generations can thrive through the process of rewriting more sustainable money management stories. Dan and Dana make their home in Southeast Denver area. They have 3 children, Brendan, Elena, and Liam. In their spare time, they enjoy live music, Colorado's major professional sports team, hiking, camping, and spending time in the Colorado high country. Dan, welcome to the show.
Thanks, Bill. Appreciate it. You didn't say campfire karaoke.
We did, yeah. Dan, you and I have known each other for a long time, and we actually do have a traveling band. Most people don't know that.
We have fun.
We sing awfully. Attracting all of the camp rangers from around the area.
That's right. They know us on a first name basis.
That's right. So Dan, tell me a little bit about your background with behavioral financial planning. Tell me a little bit more about that, because I think that's a unique focus that not a lot of financial planners have.
It is unique, although it's growing. Thankfully, it's growing. I practiced in the financial planning profession for 15 years before I decided to start pursuing the behavioral side. And that really came about because it over that 15 years, it would drive me crazy as I would be working with clients who it wasn't a math problem for them. They had enough income, but they could not find their way out of their own way, if that makes sense.
Yeah.
And seeing clients struggle is nobody likes to see people struggle, and especially not the advisor on scene, if you will. So it became evident to me that in order to truly help people, it was an area that I needed to grow in as a professional, to be able to help people identify what might be some of the root causes of their self-defeating behaviors. So that was really the genesis of it. As you mentioned in the intro, my wife is a clinical psychologist. That certainly helps because I pick up a lot from her as, we're talking over cooking dinner, or we're talking around the table. I give her full credit.
Nice. Yeah. And Dana is a smart lady. So, this has been a really difficult year, both for stocks and bonds. The Barclays aggregate bond index is down around 13% for the year. The S&P 500 has gone into a bear market. What are some of the things that you are telling your clients to be thinking about as they're thinking about investing?
Yeah, that's a great question, Bill. It is tough. It's been a tough year. In particular, these last few weeks, it has been difficult. And I think big picture, we need to keep things in context. just to throw out a little bit of context for the audience, there have been, since World War II, there have been 17 bear markets for the S&P 500 index. Now, the catch is, if the economy is in a recession, which was 9 of those 17 times the economy was in a recession, the ultimate drop on the stock market is about 35% on average, and it lasts for more than 15 months. But without a recession, which is 8 of those 17 bear markets, and that's currently the case, we're not in a recession, the down is less than 24% on average, and they last about 7 months. So none of us, neither you nor I nor anybody in our audience, has a functioning crystal ball. We don't know where this is headed, but we do have the ability to rely on history and look at historical bear market environments. And I think that they at least can provide us with some insights about what might happen this go around. So I do think trying to keep our feet underneath us and keep our heads about us is important, and that does tap into that behavioral side of things too. So that would be number one.
So I hear don't panic.
Don't panic.
Right.
Don't panic. I mean, it's the worst time to get off a roller coaster is in the middle of the ride, right?
Yeah.
So don't panic. There may be, though, some things that people might want to consider inside of their portfolios if we're talking about their traditional investments, and that may come in the form of stop loss protections that that could be triggered. It may come in the form of different bank notes that that are available. So there are ways that investors in traditional investments, mutual funds, stocks, and bonds, can shield themselves from more catastrophic losses than what we've seen so far this year. Nice.
So there are a lot of misconceptions about financial planning. I think in a market like this, it certainly helps to have a professional like yourself. But a lot of people think that financial planning is really only for, the top 2%. What would you say about this, and what role, does real estate play in overall wealth creation from your perspective?
That's another really good question, Bill, and it's true. And I think that the financial planning community has done the general public a disservice in the way that it's handled itself over the past, I'll say, 20 to 30 years, and defining minimum asset levels that unless you meet this threshold of $1 million or $5 million, the financial planning profession has been relatively inaccessible. Thankfully, in recent years, I think that the financial planning community is waking up to a new generation of investor who may not have the traditional net worth that investors of the past have. A lot of people we're running into today, whether they're millennials, Gen Xers, or in the baby boom generation, have built their wealth through real estate. And while maybe their investable assets, their mutual funds, stocks, and bonds don't meet those minimums, on a big picture, their net worths are every bit as healthy as investors that we've worked with in the past. I can speak for our firm that we don't carry investment minimums any longer to work with. We never did, actually, to work with clients. We have the ability to work with anybody who walks through the door. I joke, but it's true. Our biggest qualifier for a client to come on board with us is they have to be more invested in their future than we are. I mean, we can't care more about their future and about growing financially than they do. So it is a misconception. At least I'm seeing a growing tranche of the financial planning community that's growing to realize that there are a lot of people who may not fit that traditional investor of the past that need our work and that are very willing to pay us for it, and get the advice that they need.
So when you look at somebody's overall picture, let's say that they're a new investor or a millennial or a Gen Y, or we have a lot of those listening to the show. Is there a mix? Is there, in terms of traditional investments versus real estate? Are you pro, because a lot of folks that are listening to the show, they're like, do I rent? Do I buy? What do I do right now? What would you tell somebody who is looking to grow their wealth and they're just starting out? Where would you instruct them to go?
Well, hey, right now, you and I both know, and I think our audience knows, the biggest buzzword right now is inflation. What's the biggest inflation buster out there? Well, I can name two of them: stocks, equities, traditional equity investments, and real estate. Mm-hmm. So I think real estate is a fantastic hedge. It historically proves out to be a fantastic hedge against rising prices, inflation. So, what's the right balance between a traditional stock, bond, mutual fund portfolio and real estate? I don't know that there's a right answer to that. We do want to make sure we see our clients with a certain amount of liquidity. We think that's important. But to the extent that a person can check that box, I think it starts to come down to personal preference. Some people are more comfortable with tangible investments.
Or when you start too, I would argue.
Yeah.
If you're starting early, it's a great time to start in insurance. You know what I mean? Because you're young and you're healthy.
Right. Absolutely. Yeah, absolutely. So I think, there's personal preference. And look, every investment vehicle, every financial instrument out there has its own time and place. I am really tired of the message that such and such investment, whether it's, an investment or a mortgage product, you name it, that though they're always bad, they're all wrong. You know what? These are forks, knives, and spoons. You know that, and I know that. And if you deliver to my table a bowl of soup and you bring me a butter knife, there's nothing wrong with butter knives, but it's the wrong tool for the job. Okay? So I think we need to move past that as professionals in looking at any individual product as being either always good or always bad. They're amoral. There's a right place and a wrong place.
Yeah, that makes sense. Yeah, because we see that. I was just having this conversation actually last night about, with inflation and higher interest rates, ARMs are becoming a lot more popular, but a lot of the millennial generation and Gen Ys are deathly afraid of a short-term ARM type of product because they watch their parents lose their homes, right?
Yeah, the mortgage crisis, right?
Yeah. So, but it, like you're saying, it's just a tool, right? And applied correctly with the right amount of education and understanding and timing, they all work.
Absolutely.
Cool.
Absolutely.
So let's get down to the bottom line. With markets being down, as we said earlier, people are, hurting and they're concerned. While having a financial advisor might seem like the wise thing to do with markets performing so poorly, are your fees really going to be worth it?
That's a $1 million question right there. That's a really good one. The truth is, there's no way that I can make a guarantee that I will bring to the table an excess rate of return above and beyond the fee that I charge to manage a person's assets. Compliance managers around the world would explode in flames if I made such a claim. But there have been multiple well-written, well-documented studies that show the value of a financial advisor, and break that down. Vanguard investments of all investment companies. This is the investment company, Bill, that is 100% devoted to showing the general public how they can do it themselves. They have a study that breaks the investment value, the value of an investment advisor, down to a percentage. And they're very clear, and I think it's about a 20-page white paper that they put out, that they break it down to the minutia of what a financial advisor can bring to the table. But in the end, in totality, they quantify that to about an extra 3%. Now, is that guaranteed? Not guaranteed. You could hire a lousy financial advisor just the same as you could hire a lousy mechanic. But if you're working with a qualified and experienced financial advisor who brings to the table asset allocation knowledge, who brings to the table behavioral capabilities, they have the ability to quantify that. They've been able to quantify the value of that over time. So doesn't mean that markets are always going to go up, but working with a trusted advisor, I think, with your money makes just as much sense as working with a qualified surgeon when you need heart surgery. I'm sure that there's enough information out there on the web that would teach you how to do that yourself too. But you and I both would never venture into that.
Well, so what would you qualify a good financial advisor? Let's talk a little bit about that. And how is, you talked a little bit about your behavioral science and psychology background. What advice would you give somebody who is coming to you for the first time? And how does your firm sort of stand out in the way that you guys do business?
So, first of all, we are 100% about the relationship. We are relationship oriented. So, there's the big companies out there that you can work with, and that from a price standpoint, they may be able to beat us from a price standpoint. But what you get with those companies is an 800 number. And every time you call, you get a different representative in a call center. When you work with us at Latitude Financial Group, you get a relationship. Okay, you're going to work with me, or you're going to work with my business partner, Scott. Bill, Scott. Mm-hmm. And we're all about the relationship. We're on that journey with you from where you are today, and whatever that may look like, to taking you down the road and giving you the best advice we can possibly give to getting you to your destination on time, or preferably earlier than expected.
Yeah.
And, that's a vow that I've made from day one. I've been doing it for 20 years. But when I give advice to my clients, I give it in such a manner that it would be advice that I would take myself if I were in their shoes. And I've done that for 20 years. It's never failed me, and I won't stop doing it. So
it's interesting that you say that too, because that, our business is the financial service related business side of things it should be very relationship oriented. And there is a percentage of folks that go after price. And we see it on my side of the business. We see it on your side of the business.
Yeah.
And there's always going to be a segment of the market that goes after price, but that segment of the market doesn't necessarily value good advice. So what would you say to those folks, the folks that are going after price?
I think that going after price, as opposed to going after a relationship with a qualified advisor, is short-sighted, and that in the long term, while you think you're getting ahead because of efficiencies in the price, what I think turns out long term, and again, this is one of those intangibles, no way for me to guarantee this, but I think long term you're going to pay more. because of either mistakes that you made that you wouldn't have otherwise made had you had a qualified advisor who was attentive to your circumstance. So mistakes that you would have avoided, you made, and that there's a price to that too, right?
Yeah.
So that I think I'll leave it at that. I mean, I think that sums it up right there, is why we work with advisors. Look, if you and I are going to go jump in a raft and jump and ride down the Arkansas, in spring runoff, I'm going to tell you, we better get a guide on that boat too. I know the area, but I don't know the river like a guide knows it, and I'm not doing it without a guide.
Yeah, because they're going to steer you away from the trouble, because they've ridden the river in all different types of season, right?
That's exactly right.
Yeah. No, great advice. Great advice. Well, Dan, this has been a fantastic conversation. You're a good friend, longtime friend of mine. And so it's great to have you on the show. If folks want more information, what's the best way for them to get a hold of you?
Phil, first, let me thank you for inviting me to be on the show. It's been a pleasure, and I've really enjoyed our conversation. The best way to get a hold of me is by email. Send me an email. It's dan@latitudefinancialgroup.com. That's LATITUDE financialgroup.com. And I'm attentive to my inbox. I will get back within a 24-hour period, if not same day.
Awesome. Well, this has been another episode of Bill the Lender podcast, and where we talk about all things financial service related and how they affect your real estate and real estate finance. Until next week, we'll see you soon. Take care. All right. Thanks for listening to Bill the Lender podcast. Please reach out to me with any questions at 303-877-6323.